Hello and welcome. I'm your professor, Stephen Wallen, and right now we're working on homework help for Chapter 7. Let's begin, shall we? Let's go. Yep, let's go. Here's what a monopoly is. So monopoly, even though monopoly being all-powerful, you're still held to demand. So right here we have our demand line. And I think it's interesting, our revenue is always going to be smaller than demand. Why is that? Well, because as a monopolist, if I charge a certain price on this line, let me show you. If I charge, let's say I charge here on this line, okay? What happens is everyone that's willing to pay more for it, so this guy, this person right here, these people are now paying less money than they would normally be able to pay. Like this guy would be willing to pay 13, but because I put it at that price, because I want to sell to more people, he's now only paying me how much money? 11, okay? So I lose $2 from that person that I could have had. I lose $2. But the second guy was willing to do it at 12, but now that the price is set at 11, I'm losing $1 I could have gotten from him. But even though I'm losing money by charging it at that price, because I could have been getting 13 from him and 12 from him, what do I gain overall? Well, then I gain this person down here that's willing to pay me 11. Okay? So yes, I had to lose $2 in revenue from that guy, $1 in revenue from that guy, but I'm gaining $11 in revenue from adding that next customer. And this is what happens as you go down the line, and this is why this line right here will always be steeper than your demand line, because we can't separate those people and charge them individually what we want. If we could, then we'd be very, very efficient at milking the market, okay? Whenever you're able to charge people the most they're willing to pay and segment them off, you're doing well. If you don't have a mechanism to do that, then by default, as you lower your price to sell to more people, well, then you're cannibalizing a little bit of these other people as far as the money they were willing to pay you, because then they'll just buy it at the other price. And so you have to find a happy medium there. You have to kind of see how that all works. So let's go down here and see what we got. What is the highest price the monopolist could charge and still sell at least 1 pound of fish? Well, here they're selling, let's take a look at this. Here they're selling 9 pounds of fish. Okay, and there's still demand for it. As long as there's demand, you can sell it. So, is there demand? Yes. 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 If you notice, this is where demand stops right there at 1. One guy's willing to buy it at what price? $13. So theoretically, we could do that. We could sell it at 13, but we only get to sell to one person, because we're still, even though we're monopoly, we're still have the restraints of demand. What is the total revenue at the highest price? Well, if you're only selling one, then your revenue is going to be 13 as well. Like, that is your revenue. You sold one. Good job. All right. If the price is reduced from 13 to 18 total revenue, okay, they want to know it's going to, total revenue will what? Okay, so if we go from 13 to 18, let's clear all of this off. If we go from here, 13 in price, and we reduce it all the way down to 8, what do we see happening with total revenue? Revenue's going up. Remember, this isn't profit, this is total revenue, but by default, yeah, we are making more total revenue, okay? We have total revenue going up. The idea, though, is to get total profit. That's what a monopolist is always going to work towards. So based on this alone, it now is at 48. What is the value of marginal revenue as price is reduced from 8 to 7? So 8 to 7. Let's go ahead and take a look, see what we have. Price, we lower it from 8 to 7, we go there. We lower it from 8 to 7, we go there. So we end up with getting how much more? One more in marginal revenue, which makes sense. We're going from 48 to 49. So just be a simple 1. Let's see if we did it right. Moment of truth. And all green. All right, let's move forward. Moving on, moving on. So the main takeaway here is that as we sell more, we're getting less money per person, but we are adding more people, and so we have to kind of find that happy balance, and the happy balance will be explained in these future problems, okay? The way you maximize money is you have to find the sweet spot. Okay, at what rate of output maximizes total profit? I'm just going to tell you straight up. As a monopoly, you're going to have it where MR, marginal revenue, equals what? Marginal cost. So let's take a look and say what this actually means. Marginal means per. So if my next unit costs me $4, but my overall marginal revenue goes up 5, would I do this? Yes, because then I would still get what? I'd still get $1, okay? And let's say my marginal cost went up to 4.5. And let's say marginal revenue went down to 4.8. Would I still do it? Yes. I'd get 0.3 at that point. As long as marginal cost is below MR, you keep selling. However, at some point, because when you sell, you're also changing the profit of what you were making on all your previous orders are, because you're basically working directly off the demand line. When these equal, you stop. Just like how MC, marginal cost, equals price, you stopped. Same thing. When MR equals MC, same thing. You keep going until you stop making money. Whenever you stop making money, that's the stopping point. Okay? Rate of output maximizes total profit. Well, where does MR equal MC? Here's MC. Here's MR. And so let's go ahead. Let's, right there is our point. 4. Perfect, we're good there. What is the MR at the rate of output? Okay. Well, we got 7 there. We're making 7. And what's the price? I think it's interesting. Marginal revenue 7. Price was always going to be what was the max that we can charge. So whenever you look at the price, this is where we're going to produce. The price that we're going to be charging is right here. We're going to charge what demand's willing to let us charge. So we're going to charge this 10 right here. And we're going to be producing all into there. So that's our cost right there. So for each unit, we're making $3. Okay? $3 a unit. As if we were a monopoly. That'd be our optimal thing. If output is increased by 1 pound beyond that point, MC is blank. Okay? We go up 1 more pound at 5. Let's draw this out. We go up 1 more pound at 5. You see that MR is at 5. However, what do our costs end up at that point? Okay. Cost right here at MC be at 9. And if our costs exceed marginal revenue, would we ever produce there? No. So MC, therefore, by default, is greater. And you wouldn't produce there as monopoly. I think that's interesting, though. If this was a perfectly competitive area, though, what would, in the long term, where would prices go to? Or where would prices and quantities go to? Well, if this was a competitive area and we had multiple people producing, in the long run, you would always go to where ATC is most efficient, right here. So the market would end up producing at $8. They'd sell it for about 9 here. Close to 9. A little bit above, it looks like. And they'd be doing almost 5 pounds of fish. So basically, as a general rule with monopolies, when you have a monopoly in the system, it's going to cost more and they will produce less because they're trying to maximize profit. If it's an efficient competitive market, they will always produce more and bring costs down if it's a competitive and efficient market. Okay? And that's it. This is where monopolies would produce right here. They produce this. You have a much bigger margin. They produce less. It's a higher price. And if it was competitive, it would end up over here. The price would go down. And that'd be it. Alrighty. Let's go ahead and move on to the next one. Actually, no, let's check it. Always worth checking. Make sure we got it right. Do we see all green? All green. All right, we're good to go. All right, we're already on number 3. Here we go. A lot of boxes. Marginal revenue. So in this one, basically what's going on is we just got put in the revenue going from one to the next. So right here, you can see we're going up 1, 1, 1, 1, 1, 1, 1, 1. It's always a 1 in between. 10 to 11 is a 1 difference. 11 to 12 is 1. 12 to 13 is 1. However, over here, though, these are where we're going to be doing our differences for marginal revenue. So 250 to 264 is going to be 14. 264 to 276. It's going to be 12. And then 276 to 286 is going to be 10. You're going to see a pattern here. 286, 294 would be 8. Then 6. Then 3000 to 304 is 4. Then 2. That's our marginal revenue. I just want to know per when we're moving, what's our marginal revenue changing to? So let's pop those all in real quick, shall we? Remember, marginal just means the next one. So we're looking at the differences from when we go from one step to the next. 8, 6, 4, 2. All right. And let's double check. Clear all this off. All green. Perfect. All right. Now let's start mapping this out and seeing what this all means graphically. So let's go ahead and start with our demand over here. Okay. Demand is pretty simple. You're just going to take this point right here and coordinate with that. So at 10, we go down here, right? Here's our quantity. At 10, we have 25. We have demand selected over here, so we just can pop that on. Pop. And then 11, 24. And then 12, 23. And then 22 to 13. 14 to 21. 20 to 15. 19 to 16. 18 to 17. Boom, there's our demand. Okay. Now, let's do our marginal revenue, shall we? Okay. Actually, let's do marginal cost. We'll start with marginal cost here. Then you're just coordinating this to over here. So marginal cost, we come over here, 10. We start at 4. And then we're going to go 11.6. And then we're going to be at 12.8. And then 13.10. And then we're going to go over here, 14.12, 15.14, 16.16, 17.18. Oh, let's see. There we go. You have to be careful on those ones when they connect. You basically have to click it when it's not highlighting the other thing, so it actually puts your point in for you. And also just double check it up here. It's going to say this has 8 points, this is 8 points, this has 7 points. So we got 8 points. 1, 2, 3, 4, 5, 6, 7, 8. We're good. Let's work on MR, shall we? MR, we got 14 at 11. 11, 14. And then we have 12-12. Then we have 13-10. Oh, back. No. This is where you have to fight the graph. You're trying to get it in there and get it to cross, but not go over that one. Rather than redoing everything, you can undo your last point over here, so undo it. We're gonna get it in. Boom, we did it. So you want to be right close to it, but don't click on it or else it's gonna just transfer you over to the other line. So those are really tricky to get in on these graphs. All right, then we're gonna go 12-8. Oh, sorry, not 12-8, 14-8, my bad. 14-8, no, I wanted 14-8, not 14-9. 14-8, 15-6, and then 4, then 2. Boom, all right, we got our good looking graph there. Okay, so some things to notice. Remember, here's our demand. What are you going to see with marginal revenue? It's going to be going the same direction, but it's going to be a steeper slope, okay? And you have marginal cost coming across this way. At what rate of output is MR equal MC? Where do they both cross? Right there. They cross at 13. What price will monopolist charge for that much output? Okay, so monopolist right here, they're going to produce here at MR equals MC, and they get to charge this huge, giant chunk of money right here. They get that huge margin. So it's going to cost them 10, and they're going to be charging you guys at like the 22 mark. Okay? And you notice if they were to produce over here more, what happens? Well, then they have a much smaller amount coming in, and they're just not going to be making as much. This is always where you maximize profit. MR equals MC. Okay. What price will monopolists charge for that output? Like we said, that's going to be $22. The market were perfectly competitive. What price would prevail? If it was perfectly competitive, well, at some point, what's going to happen in the market? Well, factors are going to make it so that people produce all the way to where demand is, as far as these connecting. Like MC is going to get to where demand is. They're going to start producing at this point. If it was perfectly competitive, okay, you'd get to this point, because basically you eat up all the profits and they kind of become normalized. So you'd be producing, it'd sell for 18 and you'd be producing at 17 units. What price would be real? They want to know price, not the units, so you're going to be looking at 18. 18 is going to be the price. And then they'd be producing 17. If it was perfectly competitive, let's take a look and see what changes when it's competitive. When it's competitive, MC is going to be touching where demand is. And overall, what we can see is we're now producing 17 units as opposed to 13 units. In addition, prices go from 22 all the way down to 18. So when you have a competitive area, what's going to happen? Prices go down and quantity will surge up. They will go up right there. All right, and let's check and see if we did it all right. Green, 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 100%, green, green, green. That means we're doing good. Doing good like we should. All right, moving on. All right, so this little article talks about drug companies. And basically, drug companies, for the most part, are monopoly. If you scan here, there's a whole bunch of information. At the end, we're just going to pay attention to it at the end. Consumer groups have said that Cardazine sells total about 700 million a year domestically. Users of Cardazine were paying about $73 a month for the drug when a generic costs about $32 a month. So we're assuming the generic is in a competitive market. That's why it's generic, okay? It's a place where they've kind of moved to a huge point of efficiency. So let's go ahead and let's take a look at this. They're charging 73. The generic costs 32. How big of a profit margin is that for them? Well, handy dandy calculator, because we're lazy right now. 73 minus 32 equals $41. That sounds good to me. $41, okay? How much profit per year per user might the producer of Cardazine have been making if their average total costs were equal to that of the generic substitutes? We're assuming that it costs the exact same for that monopoly people to make their drug as the generic. The only difference is that they're able to sell it at a high amount because they have protection in the market. Okay? And so with the $41, we then times that by 12, because they're taking this a month. It says right here, a month. No, bad. 41 times 12. There we go. 492 per user. When you're making almost 500 bucks a person and you have enough customers, that's some serious money coming in. And that's profit. So there's a reason why they got such huge lobbying firms. 492. Let's check it. $4.92, and if it was competitive, it would be at 32. If it's competitive market, because that's where they're saying the generics are able to make it at. So always remember, monopolies will always produce less, have a higher margin, and make more profit, and it'll cost us more with a monopoly. If it's a competitive market, you will see prices lower and quantity increase in the market if it's competitive. And you can't fault monopolies for doing that, because they're always going to do what makes them the most money. Okay, doesn't mean they're going to raise it to insanely high, because at some point that still doesn't maximize profit. Monopolies are still bound by the demand curve, and they will still do what makes them the most money. And that doesn't mean charge the most possible, because if I charge the most possible and only get like 1 or 2 people buying it, I'm not going to make much money. So they're still bound by the demand curve. That's the main thing to get out of this. All right, let's move on, shall we? Almost there. Bringing it in. Here we go, almost. OPEC. Okay, this is basically all the Middle Eastern countries that work together, and they have a consortium where they work together, and they basically say, let's all do the same thing and work together to keep things going well for us as oil producers. It's an open cartel is what they call it, so it's not a hidden cartel, and they basically tell everyone in their group what to do. According to the Newsline, OPEC ministers agreed to keep their daily crude production target at what level? It says right here they believe to keep it at 30 million a day. Okay. And basically what's going on in this article, if you read the whole thing, OPEC works together, they set targets, and they basically tell each other what to do to have things be what they need to be. And I think it's interesting, OPEC, when they were fighting Shell, because this is a little bit older, I'm pretty sure, and like people that were producing gasoline from shale and other obstacles, they actually decided to keep the price low so that people wouldn't enter into the market. They wanted to keep barriers, put in a barrier of entry of profit, where basically like, hey, you're not gonna make enough profit, it's not worth coming into the industry. And then once those people went out of business, then they shot the prices back up and withheld production. So, and here we go. This is just common knowledge over here. OPEC produces less than a third. That doesn't make sense. They're Middle East. More than 1/2. Well, they're just the Middle East. I mean, you got Russia, you got Venezuela, you have America. I mean, all the countries produce a lot of oil. It's gonna be more than a third, though. Okay. Yeah, that looks right. Everything looks good. Yeah, that's it. Alrighty. So basically, remember, OPEC is basically a bunch of countries that have an open cartel and they work as a monopoly. It's mimicking a monopoly. Even though there's multiple people in it, they literally work together as one to do their decision works and to not fight against each other and to make things go well. So it's an oligopoly, basically. All right, and we double check it. Check my work. See, are we good? Are we good? The green is there. I see the green. All right, everyone, take care. That was question 5. See you later.